Before we start with the lessons that look at trade strategies from entry to exit, where we combine the dual time frame momentum, end pattern, and price, put them all together, I want to go over a little bit on how we display different momentum indicators and dual time frame position, and then also introduce you to something we haven't gone over yet, which is called dual look back. Reversal signals. So let's begin with dual time frame indicators. So we've talked a lot about that already in this chapter, and where we look at the position of the higher time frame momentum and then go to the lower time frame momentum to execute a trade, or for the final setup of a dual time frame momentum trade strategy. So there's a couple things here. I'm going to show you how to kind of approach putting these on your charts, both if you happen to have the Dynamic Trader program, that's of course my own program that I've used throughout this course, or if you have some other program. So I'll start with the Dynamic Trader program because I have programmed in a couple sort of special things for the program just to make it easier to understand the dual time frame position. So let's begin with, this is the S&P weekly data, and this is the DT oscillator in the indicator window. So all of I've done here is I have noted on the chart where the indicator either had made a bear reversal, such as here, or where it reached oversold and then made a bull reversal, which bar it did. So on this bar, that the SPX made a weekly momentum bear reversal on that bar. We can see it down here. So, of course, that reversal is not made until the end of the bar. This is weekly, so it's on a Friday. So that means beginning the next week, our trade strategies are going to be oriented around the weekly momentum being bearish. And of course, that weekly momentum position can't change until the end of the next week. So we have another complete weekly bar. So here the weekly momentum was bearish. It was bearish on this bar. About 3 weeks later, the weekly momentum reached oversold. So I just have weekly momentum oversold. And then 1 bar later, the weekly momentum made a bull reversal. So I've just noted this on the chart. I don't usually note this set like that on my charts because I can just look at the indicator, but I'm bringing this up to you because one, you may want to note it on your chart, and number two, I'll show you in a minute when we look at the daily momentum and indicator, how it displays the weekly position at the same time. But just to go through here, the weekly momentum as of this bar reached overbought, and because this particular oscillator tends to oscillate and cycle between oversold and overbought, and doesn't hang in the extremes like in a bull trend in the overbought zone as long as, say, the stochastic does, or even the RSI, is I just want to be aware of when it reaches overbought. Typically with this indicator, a price reversal is made within 4 bars of reaching overbought or oversold. So whatever the time frame it is. So it's just a warning. It's something you want to know. The way I phrase it is that if this DT oscillator at least reaches overbought, the upside is probably relatively limited in time and price before a price reversal is made. And boy, sometimes it's not the case. Sometimes it stays a lot longer in a strong impulsive bull trend than just 4 bars. But we just want to be alert of the position, particularly anytime it makes a bear reversal from the overbought zone. Like at this, that's what it did at this bar. You'll see why in a minute. I'm bringing all this to your attention. So it wasn't until about several bars later the indicator remained bearish and never reached the fast line, that's the red line, reached the oversold zone, but both of them didn't. So it didn't reach oversold, but it made a bull reversal on that bar, and then it's been net bullish ever since. And eventually, even though it had a dip here on the following week, eventually continue much higher following this bull reversal. So that's what's been happening on this weekly data. Let's take a look at the daily data for pretty much this period of time. And this is the reason I wanted to point that out on the weekly chart for you. This is daily data for the SPX for pretty much the same amount of time. What I've done with this indicator in DT, and you may be able to do this with whatever trading software you use. I've really never used any other program but this for almost 30 years. Maybe not quite that long. And I've developed it, put in it everything that I wanted to have in it. So I'm not really familiar with a lot of other programs and the flexibility they have for programming. But here's what I've had done here for this is the DT oscillator, the daily oscillator. This is daily data for that period. Most of the period we're looking at weekly. So in the oversold zone, it's green. That just means representing that the weekly momentum is bullish. So what I'm doing is I'm putting in one window the position of the daily momentum and the weekly momentum. If it's a light red, like in this period of time, and which that looks like a long period of time, but it's only like a week or so long. Keep in mind, this is daily data. These represent the position on the weekly momentums. If it's the light red, that means it's overbought. If it's the darker red, it means throughout this period, the weekly momentum was bearish. So for dual time frame momentum purposes, is in general at least, if the weekly momentum is bullish, like in this section, and if the daily momentum makes a bull reversal, like it did where my pointer is, I think it's either this bar or this bar, that's a dual time frame momentum setup to continue the weekly bull trend, which is exactly what happened. If the daily momentum makes a bear reversal, while the weekly momentum is overbought or bearish, that has the potential for completing the higher time frame weekly high. So it was literally on this day that we had what we call dual time frame weekly daily momentum bear reversal. The weekly was overbought and the daily made a bear reversal. Let's go forward a ways. On this day, the daily momentum made a bear reversal. We can see throughout this period, the weekly momentum was bearish. So it's not perfect by any means. No momentum indicator is, because we can see that it was really good about warning us right about here that the weekly momentum was turning, and eventually it had a really stiff decline. Here's a bear reversal, another bear reversal on the way down. But then, the market had a bounce, and then went sideways. It came down to almost test this low. But the weekly momentum remained bearish, and then it made a bull reversal right here, right virtually on the day. It was 2 days later, the daily momentum made a bull reversal when the weekly momentum was bullish for a dual time frame momentum position to continue a weekly bull trend. And this was also have been the first bar following the bull reversal on the weekly. So that's probably the beginning of a 2 to 3, 4 week bull trend. And the daily momentum made a bull reversal. Again, just 1 day off the low. What a great setup on the long side. So all the dual time frame momentum setups aren't perfect, but this is just so visually we can follow it. And again, if you have any programming skills, whatever momentum indicator you use, if you can display the position of the higher time frame on the lower time frame chart, fantastic. When we're talking about weekly data, no big deal. The weekly momentum only changes once a week on Friday, so you got between Friday after the close and Monday morning just to put a note on your chart that weekly momentum is bullish this week or bearish or whatever. So let's take a look at another. Here is daily. And this is, it's also the DT oscillator. I just made the notes here. Here the daily made a bear reversal and the trend was down. On this bar, the daily reached oversold, About 4 days later, made a bull reversal from the oversold zone. That's a pretty good signal that a daily low is complete. And then as of this bar, it reached overbought. Looks like either this bar might have actually been this bar. And then this bar made a bear reversal from the overbought zone. So that's a pretty good idea that potentially a daily high is made. So why am I looking at this? Well, if we're looking at daily trends, and we might be queuing off of the 240-minute data, here's a 240-minute chart for around that same period of time. And again, the reason I'm going through this, I want you to, when you see these charts, to know what we're talking about. I'll describe them when they come in the lessons. But for instance, for this period that it's red in the overbought zone, is the daily momentum was bearish. And so when we have a 240-minute momentum bear reversal, that's a dual time frame daily 240-minute momentum setup to probably continue the bull trend, or excuse me, in this case, the bear trend. So we go through here, light green, daily momentum reached oversold, and a little darker green, daily momentum is actually bullish, and yet we can see it's not perfect. The market still continued net bearish for some time. So again, oversold, and then another bull reversal in the daily momentum all through this period. So when we have the 240-minute bullish, the daily bullish, we got to be interested in long trades. And then we have the light red is when the daily momentum's overbought, 240-minute momentum bear reversal when the daily's overbought, that the possible setup for a short. And then during this period, the daily momentum is bearish. Again, bearish reversal, while the daily on the 240-minute, while the daily momentum is bearish, is a dual time frame momentum setup to continue the daily bear trend. So you'll see these charts and some of the examples we're going to use in this section. How about for other indicators? Well, I don't have it programmed in for other indicators, but let me show you something here. This is SPX weekly data, but this is a stochastic. And the stochastic, again, it hangs in the overbought, reaches the overbought and hangs there for some time, typically anyway, before a trend reverses. So basic rules for stochastic is that if the indicator is in the overbought zone, it simply is saying overbought zone is not a time to look to sell the market as long as it's in the overbought zone. And each time that it makes a bull reversal while in the overbought zone, like it did here, that's another setup to consider long. If the indicator happens to be making a bearish, or it makes a bear reversal and is bearish in the overbought zone, that's not a time to sell. It's just not a time to initiate a long trade. And so again, we go this indicator, the stochastic for, this is for many weeks, it was flipping back around to every other bar almost from bull to bear. So, but it never left the overbought zone for many weeks. I'll discuss that in a minute. So the main thing to remember here is if it happens to be bearish in the overbought zone, that just means don't buy. It's not a setup to buy. If it's bullish in the overbought zone, that's still a setup to buy in a smaller time frame for a continuation of the bull trend. So the point would be here, and this is where the price and pattern comes in, is that at what point that it makes a bear reversal, if it's flipping back and forth here, do you say, well, maybe this is more than just a short-term reversal in the overbought zone. Maybe the whole trend is complete. Well, from the indicator itself, there's no way to know that. But that's where the price and pattern comes in, is that if the market is in a position from the price and pattern to complete a trend that's maybe lasted several weeks, and then the weekly makes a bear reversal in the overbought zone, that would be a setup that might trigger the completion of that pattern. And definitely, once the indicator leaves the overbought zone, that's why I have a little double red arrow here, the bear below the overbought zone. So the bearish reversal was made in a prior bar, and then it continued lower, unlike all of these other times that made a bear reversal, and exited the overbought zone. So that is an indication that the weekly trend has reversed, and the trend is likely to be sideways to down for 2, 3, 4 weeks anyway. Depends again on the pattern position. So here's another example, is that on the stochastic, it was just net bearish for several weeks, and then several weeks later, 1 week after what turned out to be a corrective low, it made a bull reversal and remained bullish for about 6 to 8 weeks, including bullish in the overbought zone for several weeks. So we would have been only considering net bullish trades during this period. And then at this bar, it was overbought, made a bear reversal. That is not significant in and of itself unless this market happened to be near the end of a pattern and a significant end of wave price target zone. And the next bar, this is a really negative bar, big outside bear reversal week. It also declined below the overbought zone, indicating higher time frame. Top was probably complete. So we have that. Now what about here in the on the daily? So what I've done here is I've just noted where the weekly momentum from the overbought zone made a bear reversal. This is a Friday. So as of the end of that day, it made a bear reversal. Is that significant? It's significant if the market set a price and pattern point to complete what could be a weekly trend, and it makes a daily momentum bear reversal. Well, the next Monday, it made a daily bear reversal from the overbought zone, and at the end of a probable 1, 2, 3, 4, 5, and the 127% external retracement of this last decline, which was a potential 3 and 4. So it wasn't just that the weekly momentum made a bear reversal at the end of that prior week, and then the daily momentum made a bear reversal that next Monday. It made it when the price and pattern position was in a position to complete a multi-week high. So that's pretty significant. And then it wasn't until the end of that next week that the weekly momentum actually declined below the overbought zone. But literally as of this day, the day of the top, and I'll tell you, it doesn't always happen the day of the top, it all comes together. But that's how we put the price and pattern together with the dual time frame momentum. Well, the weekly momentums were bearish all through this period. And while the daily momentum made a bull reversal at this point in time, it looks like, that day, actually it's, I think, the next day that it made it, at that period of time, the weekly momentum was still bearish. So you can write that on your charts if you want, make a note of it somewhere, but you should begin a week and know that for that week, what is the position of the higher time frame weekly momentum? If you're looking at daily and intraday data, it's just once a day. Before the day begins and you start looking at the intraday data, just write on your chart. For today, the daily momentum is bearish. It made a bearish reversal yesterday. So we only want to consider short trades unless there's some other compelling factor. And again, if a daily momentum gets oversold or makes a bull reversal, you put that on your charts and you say, unless there's a compelling reason to make a trade against the daily momentum cycle, we only want to consider long trades. And if, let's just say in this period of time here, let's look right here. that we can see that the daily momentum was bullish and the 240-minute momentum made a bull reversal. So that itself is a dual time frame daily 240-minute momentum reversal for a potential complete a daily low. And given that this was a real choppy overlapping period, that is a potential to complete a corrective low. And at that period of time, it might have been a good go-long setup with acceptable capital exposure. So the better setups didn't come until another couple of days later, when the daily momentum again was oversold, was still either bullish or oversold, and then it made bull reversals. Those would have been much better setups for the short term at least. And of course, if we're looking at daily and 240-minute data, then we're looking for short-term setups that would last a few days. So that's it for dual time frame momentum. And all this was just about how we might put it on our charts so that we're aware of the higher time frame momentum position while we're looking at the lower time frame momentum position. So there's one other thing I want to describe to you, and I call it dual look back. Now, I didn't describe that earlier in this indicator course, but I'm going to describe it to you now and show you how I use that and how you might think about it. It might give you even better reversal signals. So dual look back indicator settings and reversals are something I came up with. It's probably been 10 years now. And that I integrated with the DT oscillator at least, just so it's visually, we can see it on the chart. We don't have to have it visually on the chart. You could use the same concept with any indicator. You just, if it can't be programmed in whatever charting software you use, again, it's not something that's complicated. You can just put the second indicator below the chart. So what do I mean by dual look back indicator? First of all, let me go ahead and open this. I'm going to uncheck dual look back. So this is the indicator. I think we looked at that on just one of the dual time frame examples. This is just the 8533 DT oscillator. So it makes its bull and bear reversals, sometimes from overbought, sometimes from oversold. What I found is that there's always this, what's the exact setting? So I found, like, for instance, I'd find the one setting that's probably the best most of the time. Like in this case, most of the time for a daily data, around the 8533 is the best. But I found that a lot of times just a little bit longer look back might have also been helpful, but not waiting for the bull and bear reversals of the longer look back. So what I did is I programmed in, this is going to be dual look back, just the fast line of the longer look back. So in this case, the longer look back is the 13855. So the first primary one is the 8 look back, and then it's the 13 look back. But it only shows the position of the fast line of the longer look back. So let me go okay on this. So what does this represent? This is not the dual time frame that we had before. It's dual look back. And it's saying that when on the bar that this oversold zone turns green, the 13 look back fast line is oversold. So when we have the 13 fast line oversold and the 8 makes a bull reversal, that's a dual look back bull reversal. And it's even a more high probability reversal than if we were just looking at the one time period. So again, at this point in time, we've been warned that we already know the 8 look back is overbought. And as of when it turns red here, the 13 fast line has reached overbought. And so if we make a bear reversal in the 8, that's called a dual look back bear reversals. So every reversal is not dual look back. But when they are, for instance, this bull reversal was made, and it wasn't dual look back because you can see it's not green. But when we get the momentums in a position to where they're dual look back oversold or overbought, when it makes a bear reversal or a bull reversal, it's a real high probability reversal, very significant reversal. Doesn't happen all the time. So think now if we put the two of these together, what if we had a dual look back bear reversal while the weekly momentum was bearish? Then we've got everything going in our favor. And of course, those don't always happen that way, but it was just something visually that I had on the chart. So for instance, let me add the line in for the 13 fast line. So I can check on oscillator 2, that's 13, and the moving average 1, that's the fast line of the 13. So it's black. So you can see when it enters, this is the fast line of the 13. When it enters the overbought zone, I just change the color of the overbought to red. When it exits, then it's no longer red. So it's only coloring the overbought and oversold when the 13, the little longer look back fast line, is either overbought or oversold. So we'll have some examples with these also. Now you can do that with any indicator. In fact, let me just take off the red and green bands here. So we have basically the same information. Well, we always have the same information right here in the indicator window, is that we know the 8 indicator, the two moving averages, the raw data and the moving averages, the red and the green line. We know, for instance, as of this bar, they're overbought, and then as of this bar, the 13 fast line reached overbought. So when all of these bars are overbought, then when the 8 makes a bear reversal, that's a dual look back overbought bear reversal. Back here, again, as of this bar, that's when the green and the red lines are oversold. The 8 momentum is oversold, and it looks like about 1 bar later, when the black line becomes oversold, that's the 13 fast line. All 3 of them are oversold. When the 8 makes a bull reversal, it's a dual look back momentum bull reversal. So again, you don't have to have it programmed in. You can just put those lines on the chart and know what they mean. It's different kinds of setups depending on the indicator you use, but I'm giving you some ideas here how they can demonstrate maybe a little higher probability momentum and price reversal coincidence. Let's take a look at some dual time frame momentum, price, and pattern trade strategies. In this lesson, we're going to begin to integrate the pattern position, as we learned through the Elliott wave section, and the price position, as we learned in the beyond fib retracements, including end of wave price target zones, with dual time frame momentum. And we're going to see how the dual time frame momentum can help us to confirm the probable pattern and price position, and then to help us identify the specific reversal maybe earlier on than if we waited for a pattern confirmation signal. So when we put all these together, at the very least, they should confirm each other. And once the pattern, the price, and the momentum are basically all in the same position, all telling us the same thing, we can have a lot of confidence to develop a very specific trade strategy. Well, let's take a look. Let's begin with the euro dollar, mainly because it's one of my favorite markets to trade. As of the last bar in this chart, this is an example. I think we've used it in some of the other courses as a probable wave 5. So this is going to be kind of an idealized example, but you'd be surprised how often it repeats itself when all these elements come together. So there we are. This is weekly data and the last bar on the chart. Let's look where we're at. This is a potential 1, 2, 3, 4, 5. So potentially the euro dollar is in a 5th wave of an impulse trend going back about 9 or 10 months. So it's going back a long time ago. We're looking for potentially a major reversal, the end of a 5-wave advance from several months ago. If we're in a wave 5, this should be the final section of this trend. We've reached, I'm going to keep it real simple here, as I usually do in real life. We've reached the 162% external retracement of what I'm calling a wave 4. So we've reached, which is typically about the extreme for a wave 5. And this is the weekly momentum. It's a stochastic, 8.5 or 8.33. And the weekly stochastic is overbought. And it's been overbought for 3 or 4 weeks. So as we know with the stochastic, just getting or being overbought is not a trade signal, because the stochastic can hang in the direction of the impulsive trend for many weeks or many bars, depending on what the time frame is, just like back in this area. And if the stochastic makes a bear reversal, that doesn't necessarily signal that that weekly high is complete, in this case, potential end of wave 5 high, because the stochastic can oscillate quite a bit in the overbought zone. However, if the stochastic makes a bear reversal in the overbought zone when the market is at price and pattern to complete a trend, then it might be a signal that the higher time frame trend is complete. So that's the difference of the stochastic or any other indicator for that matter making reversals when it's oscillating in an overbought or an oversold zone, is that if the price and pattern position is such that it's completing a trend or counter trend, then that reversal could be a real important confirming signal that that trend is complete, and a signal that would be much earlier than waiting for the stochastic, in this case, to decline below the overbought area, which it eventually will if it's making that top. But by the time it does that, it's a potential that the market's quite a ways away from reversal area. So this is what we would say we're totally on alert for the price, or we've reached the end of wave 5 price. The weekly momentum is overbought. Let's go to the daily data. And our whole focus now is going to be on identifying this last advance, this probable wave 5 on the weekly chart coming up from early November, because if we can identify the end of this probable wave 5, then we have identified the end of the 5-wave impulse trend going back about 9 or 10 months. So that's pretty significant. So here's the daily data right up to the time period that we showed on the weekly chart. So again, here's that weekly wave 4, the 162% external retracement right around where the high is as of the week ending December 18th. We know that the weekly momentum is overbought. I just made a note on the chart that as of this bar, that's a Friday in early December, the weekly stochastic reached overbought. So over the next 2 to 3 weeks, which is since it reached overbought, it has remained overbought, has not made the bear reversal. Let's look down at the daily momentum. So the daily momentum on the stochastic is also overbought. And boy, the stochastic has been cycling nicely. Not every cycle overbought to oversold, but getting pretty close to it. And with these settings, all I did was move the settings around until there were minimum false reversals. And you can see it's been quite smooth for all that period of time. Now, it certainly got choppy here, but once again, impulsive trend up, chops around, and it hangs in the overbought zone for a long period of time. So if the weekly momentum's overbought, if the daily momentum makes a bear reversal from the overbought zone, is that a signal that the wave 5 is complete? Well, only if we had a ideal pattern, in this case, an end of wave 5 of 5. So let's go back and look at the pattern and price, see where we're at, and then develop a specific strategy based around the technical position. So coming off of the November low, we got a 1, 2, and it looks like just a really nice 1, 2, 3, 4, and we're probably working on a 5. Is this complete? Boy, it doesn't look complete to me. It certainly doesn't look like this last section up has subdivided nicely into a 5 wave, which a wave 5 should subdivide into. But I did just draw a horizontal line because I know that we've reached the higher time frame, end of wave 4. We have reached an end, a smaller time frame, end of wave 4, or end of wave 5, at 162% external retracement. So I drew this line because the weekly momentum is overbought and the daily is overbought. Boy, if the euro should decline and close below this area, that should mean that this section is complete. That would be a pattern reversal signal. That would mean the much higher time frame trend on the weekly data going back to March is complete. If that doesn't happen, we're going to add some data and see if this section gets fulfilled into 5 waves. That would be the ideal. So I'm going to add some data. We already know the weekly's overbought, so we know that position. And we know the pattern position up to here. Now we just want to see what's going to finish this off. Oh boy, what a day that was. That must have been a news day. Really declined sharply. Never closed below that significant close, then came right back up. Only made a slight new lower close. We'll add some bars on. We did have a daily momentum bear reversal, but again, this whole section is probably not complete. So it just doesn't look like a nice 5-wave pattern. I'm going to add some more data on, and then here the daily momentum made another bull reversal and into a new high. Where does it look like we're at pattern-wise? If this is a 1, 2, 3, 4, this is sloppy, but we could call it a smaller time frame 5. Let's just do this and see if this doesn't fit together. That's a 5. That means it's going to be a little higher time frame 3 coming up from here. 1, 2, 3. This must be some kind of 4 if that's the case. Take that out. So it's either a 4 there or coming back probably. Something along those lines. And now we're looking to finish off this section, which should finish off the higher time frame trend. So let me add some more data on here. As of the last bar in the chart, we just made a daily momentum bear reversal. And what is this? This is on a price momentum bearish divergence, new high in price, lower high in momentum. That's fairly significant. It's at least warning us that a top is being made. And then let's go back to our weekly. See where we're at with the weekly. We got to add a week or two on here. I think that would be the week ending January 1st. We're going right into a holiday week here. And look what just happened on that week. The weekly momentum has made a bear reversal. So any daily momentum bear reversal when we've finished off a pattern is probably the end of this whole trend going back to March. Well, that's pretty exciting. We've made a bear reversal here. Have we finished off this trend? Well, this is pretty sloppy. It's a possibility. So we can, because of the price and pattern and dual time frame momentum position, what I would put is a close above that low. And if the euro were to close above that close, oh boy, we have probably completed a multi-month bull trend going all the way back to the March low into, now we're into early January high. So we're in a price position. The pattern position isn't real great yet. It hasn't finished off a nice wave 5. Close enough right now, given that the weekly momentum made a bear reversal, the daily momentum made a bear reversal. Let's add some data on and see what occurs. Well, that's just some funky data left, kind of aftermarket data for January 1st, a holiday. So the market, the euro has continued up, It's made a bull reversal in the daily momentum. We know that the weekly momentum is already bearish. Where are we at pattern-wise? Let's put this all together here. I think this is just fantastic. Well, if this is a 1, 2, and this is a 3 and a 4, holy Moses, we're in wave, what's that? 5 of 5 of 5. Oh. And let's take a look at the immediate price position. Oh my gosh. Here's how we word this. I'm going to clean this up a little bit. Just take that one out. What we know as of the last bar on this chart is that we are in a position to complete a wave 5 of 5 of 5, pattern-wise, price-wise. We've hit the higher time frame end of wave 5 and exceeded it slightly. We know we're should be in the final stages, and then we're in the smallest time frame end of wave 5 target zone. And with the weekly momentum's bearish. Boy, this is when everything comes together. So we can do one of two things. We can certainly put right there at that. Well, no, here would actually be the low. A close below the wave 4 or 5 of 5 closing low, bang. We've probably finished a 10-month bull trend. And that's based on the pattern position, the price position, the higher time frame weekly momentum bear reversal position. So we're looking for the next daily momentum bear reversal to probably, there it is, signal that the higher time frame trend is complete. So as of this point in time, your trade strategy can be one of two things. When you're picking a top that's on a trend that's gone for about 10 months, I like all the technicals to be in alignment, which they are as of now. And then I want at least some minor pattern reversal signal, some follow through to that probable reversal, weekly reversal. So still a close below the December 31st close. And if that occurs, more than likely, the euro has completed a bull trend going all the way back to March. Let's add some data on here, see how that works out. There we go. As of that bar, we've closed below it. Now this bar, we traded below it, and that's usually good enough. I just like closes. Closes are really solid reversal and trend continuation signals. So did you see how we put the pattern and the price together? And the higher time frame weekly momentum and then the lower time frame daily momentum reversal finished it off. So it's just a wonderful mosaic and integration of pattern, price, dual time frame momentum. Let's look at another one. Let's take another look at the euro, but bring it right up to date. This is the euro weekly data. So back here is that March low to January high that we were just looking at in this end of wave 5 target. So now let's look at it, and I'm going to bring it right up to date to the day I'm recording this and how we use all this information. In this case, we don't have an ideal sort of setup, ideal sort of pattern position, price position, all that, but we more or less got a pretty good idea, at least of where the market's at, probably for the next few weeks, and that's good enough to make a trade. So here's what I'm looking at least, and here's how I'm using the dual time frame momentum along with price and pattern position. As of the low here, about a month or so ago, this low was made at some pretty significant price relationships. There's no, by the way, pattern that is a high confidence pattern to indicate that this decline is anything more than a multi-week low, at least not from my perspective. I've been looking at this for weeks and even months as a probable corrective decline, but every time we get to the point of a weekly low, we just have a 2 to 3 day, 2 or 3 or 4 week correction, and then an impulsive trend continues down, except for this period of time. Back in here. But so it's some sort of correction, I believe, but I'm not looking at a pattern end of wave pattern position. I'm just looking at key support and an immediate trade opportunity, in this case, based on weekly momentums and the price relationship. So this is again, it's the stochastic. Everybody's got it in their software. I just played with the settings, and I think it's once again the same settings I was using on this advance, the 833. Pretty good. They cycle pretty nicely. Not many false reversals. Sometimes they get overbought, oversold. But once again, in the direction of the trend, they'll hang in the extreme for many weeks. In this case, because it's been in a bear trend for many months, it usually hangs in the oversold position and oscillates around for quite some time. Where are we at as of the last bar in this chart? So we're going to go through how we use all this information to develop a trade strategy. In this case, for a probable weekly trend, that's a trend that would last 3 to 4 weeks. So here's the weekly momentum, and the weekly momentum made a bull reversal this past week. This week is very, very narrow range because the week isn't finished yet. It's also the week before a holiday, frankly. It's the last week in December. So this week made a bull reversal in the weekly momentum. And as we know, a bull reversal in a stochastic that's oversold in a bear market is of itself not significant. So we got to take a look at the pattern position and get down to the daily pattern to help us identify the probable trend position. What are all these price relationships here? Well, it's fairly significant in that this is the 62% retracement of this 5-wave advance. And then all of these 100%ers, there's 4 of them. Actually, one of them is within 1 pip of the other. It's overlapping. That's why the line looks thick. It's actually not thick. It's 2 different projections. So on either side of the 62%, I've taken the 100% alternate price projection of every one of these declines, all of these from the high that was made a few months ago, from that high. So they're all grouping in this area around the 62% retracement. So that's enough to have a wake-up call that it's in a fairly significant price position. Now, that's not an end-of-wave position, but it's where our good friend, the Fibonacci Queen, would say it's a symmetry position, meaning that in this zone is where every single one of these declines equals 100%. Kind of a wide zone, but right around 62% retracement. Yeah, you want to wake up and say, we may have a fairly significant low around there. It's a pretty significant price relationship. And given that this past week made a bull reversal from the oversold zone, let's go down to the daily data and see where we're at and see if there's a specific trade strategy we can identify that this weekly reversal is indeed a weekly reversal, and develop a specific trade strategy. Well, here's the daily data. I'm just showing the last few months of or really last few weeks of the daily data. This is what we're concerned with, right around in here. What's going on here pattern-wise? Well, here's how I look at it. Coming off the November low, this was an impulsive advance. In fact, I can remember back at this time, because I really like to trade the euro, is that, oh boy, we just made a wave 1 or A advance. Let's identify a correction. Well, about every time we've made what we'd call a daily low, that's been a setup to complete a correction. And but it just keeps going sideways, doesn't go anywhere. But this very much looks like a correction, doesn't it? It's not an ideal A, B, C, D, E type of correction. But it's what we just call prolonged trading range. And the daily momentums made a bull reversal from the oversold zone right at this low and then moved out of the oversold zone. They've been sort of net bullish all through this period of time. So what would be a specific trade strategy we might want to be aware of, given that fairly significant price relationships at this low to make at least a multi-week low, Given that the weekly momentum just last week made a bull reversal, it was from the oversold zone, but it's a bull reversal, while the euro has been sideways in a trading range for several weeks. And more than likely, given that the weekly momentum's oversold, made a bull reversal, the breakout's going to be to the upside, more than likely. Well, here's what we had just yesterday. Really wide range. We call it a trend continuation day, with a close above all of the closes over these last several weeks, on the daily data at least. There's the daily data. That's fairly significant. So here's the specific trade strategy. Here's the specific trade strategy I'm looking for, is the next rotation and bull reversal in the daily momentum, in this case the stochastic or whatever momentum indicator you're using, is then a setup for an immediate long position, because we're at the price for potential multi-week, if not multi-month low. The pattern position is indicating that this correction is probably complete, and we just need the next cycle and bull reversal in the daily momentum to put the daily, weekly momentums, dual time frame bull reversal to continue a weekly trend that potentially has several weeks to go. Does that all make sense? I like this example. Number one, it's a real-time example. By the time you're studying this and in this course, is that you're going to know how it panned out if from around Wednesday, December 29th, if the euro was net bullish for a few weeks. And if it is, well, we identified that in a specific trade strategy as of this day. One of the advantages of having produced a analysis, education, trade strategies report for subscribers for over 30 years, I began with the educational and analysis trade strategies reports around the mid-1980s, so it's been well over 30 years, is there's just lots of examples to draw on. Whenever I do a course, is I try to use just recent examples, because if you can't find relatively recent examples for every type of situation that you're describing and teaching, then, what's the point? You shouldn't have to go back years to find some sort of example. Because also our DT Trade Alerts report gives specific trade recommendations, we got some good ones to draw on from that fairly recently. So I'm going to take a look at one that's very recent, just a few weeks old, because there's lots of lessons to learn from it, both in how to identify a trade, how to position in the trade, and then how to protect that position, trade to units, all that sort of thing. So let's take a look at, this is the ES weekly data. So the only piece of information from this chart that I want you to be aware of is the weekly momentum. Now, this is not the dual time frame. This is dual look back weekly momentum. So the two lines are the 8 weekly momentum, and that's the basis of what we're looking for. And then, as I described, when you learned about dual look back, then this is red zone is when the 13 fast line was overbought. So we call that dual look back overbought. And in the lower left-hand corner is where we always have all the details of what makes up whatever indicator is on the chart. As of the last bar in the chart, the last weekly bar in the chart, that was the week ending November 19th, just that week before Thanksgiving, is the daily momentums made a dual look-back bear reversal. Weekly momentums had been overbought, dual look-back overbought, just for 2 weeks. And the second week, it made a bear reversal. So that's fairly significant. What I usually say when a market is in one, if it's in a dual look-back overbought position, that what I would usually, the terminology I'd use is the upside is probably pretty limited before a weekly high is complete. And if the market then finally makes, in this case, the weekly dual look-back bear reversal, is more than likely If it hasn't completed a weekly high in that weekly bar, more than likely it's going to within the next week. And more than likely this would end up being the closing high for the week, or for the trend before we made the bear reversal, weekly bear reversal. So the bottom line is, after the stock index, the ES, had been just net bullish. Look at that. Every single week is a higher high and a higher low, and all but about, looks like 2 weeks ago, it made a higher weekly close. So it looks like we're at or very near, if not completed, a weekly high in this advance. So let's take a little closer look at this and then identify a specific trade strategy. So this is the SPY daily data. SPY, of course, is the S&P ETF. And I'm going to use the SPY data and trade strategies because that's what I use in our trade alert reports. We give recommendations for either go long, go short, and the specific trade strategies and how to adjust the stops. And I use the SPY. We have a list of ETFs, bull and bear ETFs. You can use those. A person can, like I've mentioned throughout all these courses, is don't let the analysis go to waste. Is you may not be comfortable with highly leveraged futures markets, but there is always unleveraged bull and bear ETFs, are just mildly leveraged, 2 or 3 times leveraged bull and bear ETFs. So take advantage of the information whenever you get an ideal setup. So here we are. This is daily data coming up from that October low right into that last weekly bar. And boy, here's where it all was really coming together nicely. Really looked like a 5-wave advance, and that these last 6 or 8 days were the wave 5. And so when the wave 5 was complete, that should complete the weekly high. And as of the last bar in this chart, the weekly momentums had actually made a dual look-back bear reversal. Now that bear reversal, the weekly momentum bear reversal, was a little short of the ideal end of wave 5 price zone. Pretty close, not quite there. But potentially, and this is the thing that was intriguing to me and why it was such a wonderful setup, is that probable 3, 4, and then this wave 5 looked like it was subdividing into 5 waves very nicely. And as of the last daily bar in the chart, let's go down here and let's look and see what happened as of the last daily bar, is a daily momentum bear reversal. And this is the dual time frame in this indicator window. So these are the daily momentum oscillator. And then if it's red above, that means the next higher time frame, the weekly, is bearish. And of course, that's what it was all during this week. The week before, it was overbought. And then for those several weeks prior, it had been bullish. So this is weekly momentum bearish. Daily momentum made a bear reversal, and potential wave 5 of 5 at this reversal day, just short of the end of wave 5 price target. This is as good as it gets. And so we've got dual time frame pattern and dual look back pattern as well in the weekly. Dual time frame daily weekly reversals. A beautiful 5-wave advance where the end of wave 5, or the wave 5, appears to be nicely subdividing into 5 waves. So my recommendation, and by the way, I take my recommendations as well, was that because this was in such an ideal position to have completed a wave 5 of 5 and a weekly high, is to go short on a lower close the next day. Because we've already had the daily momentum bear reversal, and this prior day we had, this is actually a reversal day, closing below the close of the prior day. So if we get another lower close the next day, go short on a lower close. And if you happen to be long, of course it depends on your time frame, but if you happen to be long and you trade like weekly trends, this would be a time to stand aside rather quickly because it looks like we're about in a position to complete a weekly high. Okay, let's follow up on this. So let me add some data on here. Oh boy. Fantastic. So here's what happened the next day. A new high right into the end of wave 5 of 5 price target zone. And then it made the SPY made an outside bear reversal day. And this is what we call a 3-close, it looks like actually a 4-close bear reversal. And that's when it made a new high, and then it came down and made a close below the closes in this case. It looks like the last 4 days. That's a really strong reversal signal. So it was short on the close, and of course, where's the protective buy stop? 1 tick above the high prior to entry. So our trade position is short on the close with a protective buy stop a tick above the high of that day. So let me put that in, and then let's follow up on this trade and see how it's managed. Well, let's add some data. There's a bar. We don't like to see that. If we have a outside day 4-close bear reversal, we like to see some follow through, and that's not encouraging either. And plus, the daily momentum has already made a bull reversal. Keeping in mind that our decision was made based on the pattern position, wave 5, probable wave 5, and the weekly momentums being bearish. Those were 2 of the key pieces of information. Oh, there we go. Big, strong decline. So where can we adjust our stop at this point? Well, we certainly wouldn't have it any further away than the close above that little corrective high. So let's adjust it to there. If for some reason the market turned around quickly, we would have a small loss. And frankly, given that this is a gap down day, we probably, not probably, but I think we did adjust it to break even. But let's just add some more data and see where we're at. Another up day, and then, a strong down day. So we definitely have now adjusted our stop on the full position to break even. Let me put some retracements in here, and keep in mind that we always trade a position as if there's 2 units, always, always, always. And we trade 1 unit or half the position as if, in this case, the ES or the SPY were making a corrective decline. Now we anticipate that it's a lot more than just a correction to this 5-wave trend, because the weekly momentums have made they've made bear reversals, and typically they'd be sideways to down for 3 to 4 weeks. So we should have quite a ways to go on the downside. So let's, however, if we're wrong about that, certainly if the SPY gets anywhere near the 50% retracement, and if daily momentums where they're already oversold, they're doing what's typical in an impulsive decline, and that they're hanging in the oversold zone, just like during the impulsive advance, they hung in the overbought zone. So this is not unusual behavior at all. It's actually encouraging for the downside. So let me add some more data. Oh boy, that's very encouraging on the downside. So what's the trade strategy? Should we adjust or stop? Should we look to exit the market? Well, I can tell you exactly what I did. Is because the market had come down strongly to near the 50% retracement, and the daily momentums have been oversold for some time. My recommendation was to exit 1/2 of the position on a higher close and maintain the second half of the position at break even. There's just no reason to adjust the stop yet on the other half of the position, which is treated as if the higher time frame trend is bearish, and the weekly momentums are still bearish, so there's just no reason to think that, or to bring the stop very close to the market on the second half of the position. So exit 1/2 on a close. Again, I usually exit on closes. One reason for that, instead of at a price target, or even, is that particularly after a day like this, outside a big strong down day, is typically there's some follow through on that. So I don't want to just exit because it's near the 50% retracement. I want the market to show that it's making some sort of at least temporary low by closing higher. So let's add some data on here. And bang, the next day, sharp reversal and exited on the close. And so this is exactly, let me just put that in. I'm going to make that green. I like to, when we get out of it, this becomes green. Pretty reasonable profit on the downside. And I realize that this is a ways from what the extreme was, but you're a better person than I am if you can exit all of your trades near the extreme before the reversal. So I've given you my explanation on why I wait for a close, I wait for a reversal signal of some sort before exiting, because more often than not, it seems the market continues lower. Might only be for a day or two, but you pick up quite a bit more net profit than what you kind of give back by waiting for a close, such in a situation like this. So far, still looking pretty good. Nice profit on half of the position. And the second half, or the second unit, the stop is break even. And we still have the weekly momentums are bearish, and we certainly have not done or reached what would be a typical correction in time. We'll have another course on timing, just if it was just making a correction to this 5-wave trend. Okay, let's let's add some more data and see how we continue to manage this trade. Boy, outside down day, that's typically a pretty strong trend continuation day, but no follow through and a huge up day, stopping us out of the second half of the position at break even. So the trend did not continue lower as anticipated, given that this was a 5-wave advance, just a perfect 5-wave advance, and the weekly momentums made bear reversals, did not follow through, but because of good trade identification, trade entry, trade management, still made pretty decent profit on this trade. But this was a really good example of when a market doesn't follow through as anticipated, but good trade management based on the pattern, the price, and the dual time frame momentum position, you actually end up with at least a small profit. So this is the SPY 60-minute data. Right around this time period we're talking about. This was the short that was taken and then exited one right around in here, and then the next one on the stop on this big up day. But look at this data. Let's look at pattern a bit, and then we're going to go back and look at pattern and price and momentum to see if there's another trade setup. So look at this pattern on the way down. Does that look corrective, or does it look impulsive? Well, we have certainly it's lower lows and lower highs, so that typically is bearish. However, a lot of overlaps there, isn't there? Even on this 60-minute data for the SPY, and if we looked at the ES 24-hour data again, lots of overlaps. And I mentioned that at the time that even though in our reports, even though the weekly momentum was bearish, and this was such a significant, probable at least, end of wave 5 target that should have a lot more to go in time, the fact remains this is more corrective than it is impulsive. Got to be aware of that after we got stopped out. Now let's look at this data. This is adding a few days on to the time when this would have been the day of stopped out. Is this impulsive or is it corrective? Well, this is why pattern can really, really help you out on the probable trend and position of the market. Well, this was more corrective on the downside, more impulsive on the upside. If this is a correction, what usually follows a correction? Well, eventually at least, resumption of the trend to a new high above the prior high. So at some point in time, after we've finished the initial impulsive advance, we would have another correction and then a continuation to a new high. So had to reorient, completely reorient the probable outlook, at least I did, that instead of the beginnings of a more significant bear trend, this is probably just a correction, and eventually we'd go to a new high. So we got to reorient our trade strategy. We got to be looking for opportunities to get on the long side. So I'm going to show you another specific recommendation I have on why you don't have to buy the bottom or sell the top to make money. There's an old saying from W.D. Gann, and that's the first trading course that I wrote, educational course. It was the W.D. Gann home study trading course back in the 80s, the late 80s. And it was really a combination of Gann and Fibonacci and Elliott. But Gann said there's no price too high to buy as long as the trend is up, just as there's no price too low to sell as long as the trend is down. So as long as the trend, the technical position, the trend is up and it has not reached even minimum targets or completing a pattern, is that you always want to be looking for opportunities to go long for a continuation of a bull trend. So let's take a look at a recent opportunity. So I've advanced the data. Again, we're at the SPY daily data. And I've advanced the data through, what is this? This is Tuesday, December 21st. So let's take a look at where we're at here. Number one, the daily momentum is oversold. So let's look at the pattern. Again, this was that probable corrective decline, probable impulsive advance. And then I was looking at this as a probable irregular ABC, where the daily momentum got driven down to the oversold zone, and the daily momentum had not made a bull reversal yet. But boy, this day was a strong up day, already trading well into the range of what I've got labeled as a wave A, and just a few ticks, points below the closing low of what I have labeled as a wave A. So certainly a close above this close would create a daily momentum bull reversal, which would probably be followed by a continuation of the advance to a new high. So yes, we're quite a ways off of this low, especially after this just phenomenal update. But as Gann said, there's no price too high to buy, no price too low to sell, as long as the trend is up or the trend is down. So if we're just in the initial stages of a resumption of the bull trend that will probably go to a new high, we want to take advantage of that. We don't want to wait and cross our fingers and hope that we get a nice little 50% retracement to enter. No, we want to get in on any trend continuation signal, which in this case would be if the following day the SPY would make a new high. And that was my recommendation with our subscribers. If the following day, if the SPY made a new high, go long on the close. And where to put the protective stop? Well, I don't think it had to be all the way to this low. I mean, this is a really wide range up day. So my recommendation is just put the stop below this low, the day of this low, if it gets stopped into the market on the next day. So the daily momentum was oversold. We know if it made a new closing high, daily momentum is going to make a bull reversal. Where was the weekly momentum at this time? Let's go to the SPY weekly. So this is that week, but it's a completed week. So this week was not complete. So where were we at going into that week? So that's the last completed week. And the fast line of the weekly momentum had reached oversold. The slow line had not quite gotten oversold. And this week, you saw the first 2 days. The first 2 days had already come about halfway up here. Is that what I look at this and I say, well, the weekly momentum, it's a lot closer to being oversold than it is overbought or even bearish in the mid zone. It's in a position from where a weekly low could be pretty close. You know, if it were oversold, then we'd say we'd be more confident that a weekly low is being made. But given that it was so close to the oversold zone, you know, everything's not always perfect. You got to use a little common sense. And if this is a corrective pattern and this is an impulsive pattern, and we're probably in a position to complete a correction and make a daily momentum bull reversal, want to get long this market. So let's add some days, see how this worked out. And it's going to be interesting because we went into a holiday period, and I'm actually, we'll have data right up to the day that I'm recording this. So one more day, there we go, another big up day. And I know it drives people crazy to waiting for the close, because look at where the market is. As Gann said, there is no price too high to pay if the trend is up. So we do have long at that point, stop down here. So it is pretty big distance between entry and protective sell stop. So all you do is you just do a very small position. It's that simple. And you don't do highly leveraged. You do an unleveraged ETF and a reasonably small position. So if this market should immediately turn around and you get stopped out, the loss is no more than what's acceptable to your trading plan. It's that simple. Because we're in a position, assuming that the SPY is going to continue to a new high. So this is, we're coming up to Christmas time now. I'm going to put a couple things on this chart, and then I'm going to show you how my instruction for this trade strategy. So I'm going to do the 100% alternate price projection of that advance. So my trade strategy was, because the week after Christmas, I was going to have no reports. And so I had to lay out a trade strategy for the next week for this market. And I wouldn't be able to adjust that strategy depending on the data my position was, because this whole position of this market suggested that at least a marginal new high would be made, is that if the SPY continued to advance and reach the 100% alternate price projection of this rally, is to just exit at that price. Typically, I don't like exiting at a price, but I had to give instructions for the next week. So does that make sense? Well, I thought it made sense. And more than likely, if the SPY had continued to advance, more than likely in 2 or 3 days, the daily momentum would reach overbought. So we'd be near at least a daily high. So that'd be a good time to exit the trade. How about the second unit? Now it's just half the unit. How about the second unit? Well, I recommended, because again, more than likely the daily momentums would be reaching overbought, is exit it was at the price of this 100% alternate price projection, is then to trail the stop on the second unit at one tick below the prior day's low. So if the market were to continue to advance, making at least daily higher highs and higher lows, you'd remain in the trade, get a little bit extra profit. But because the daily momentum was getting to the overbought zone, I thought it would be, and there wasn't going to be an updated report, and this is how I'd handle it. So there we go. As of 2 days later, one unit was exited. It'd be on Monday the 27th. A small profit, not a significant profit, but a reasonable profit. And then the stop on the second unit, second half of the position, however you want to call it, would be trailed one tick below the 1 day low, and ended up being exited 2 days later when it traded below the prior day's low. Well, look where we're at in the daily momentums. They're dual look back overbought, and they have been for 2 days. So not a great profit on this trade, but both units, the full position, had a reasonable profit, and we're in a position to potentially complete at least a daily high. I think we only got, let's see if This the day? This might be the day I'm recording this. Oh, should have one more day. This is today, the day I'm recording this on December 30th. Where are we at in the weekly data, or the weekly momentum? The weekly momentums are bullish and not overbought, so more than likely, we got a ways to go on the upside over the next week or two. So what would be the trade strategy? Well, I'm going to be looking next week for the next cycle and reversal, bull reversal, in the daily momentum to potentially position long again because the weekly momentum is not overbought. So we'll just have to see what is the pattern position, etc., in the days ahead, but it potentially still has some upside to go. But I wanted to show you this example because it's another example of you don't have to buy the bottom or you don't have to sell the top. You just have to buy when the trend is up, and it more than likely has more to go on the upside, and then protect your position when it gets to a point where it's at least going to be making a daily high. This data is the weekly data of the GDX index. That's the gold mining stocks index. And we follow it in our report, and there's a lot of people that trade it itself. It's an ETF. It's a great trading vehicle. Also, a lot of people who trade individual mining stocks will follow the EDX and the position of the EDX because it represents the probable general trend of at least the larger mining stocks. So it's the type of trickle-down analysis where you look at the index, which is like looking at the broad market, and then you look at the components of the index, the individual stocks, and say, well, which one of these are relatively stronger or weaker if I want to take a position in them. So that, as it said, the GDX does some pretty nice patterns and pretty nice momentum cycles. So everything that we've learned is very useful for the GDX as well as the individual mining stocks. So let's take a look at this. And this is the GDX. This is with data up through October, the early part of October in 2021, not too long ago from when I'm recording this. And again, I'm using a real-world example that we'd used in our reports as recommendations a while back. But let's look at the last bar on the chart. Here's what's important is we're going to be looking at the dual time frame momentum, a little bit of price, a little bit of pattern. But of course, this course is focusing on momentum. So this time I'm using the stochastic. Again, everyone's got that in their software program. And I just put I put the settings up. Let me show you. And I usually start with the 833 and just kind of take it from there. If I expand it a little bit, a little bit longer look back period, it lags a little bit more on the reversals. It certainly looks pretty good, certainly quite good, in fact. But the downside with the longer look back is it'll always be smoother. Of course, the longer the look back is, the more the lag. Sometimes, in this case, it can be 3 to 4 weeks after a price reversal has been made before the momentum reversal is made. So I like something that doesn't lag too much. I like to get the minimal lag and then smooth it around. And what I'm doing is I'm adjusting the various settings on here just to try to avoid the choppiness, the false reversals, so to speak. And this does a pretty good job and keeps the reversals close in. Close in means they make a crossover fairly quickly, either coincident with the price reversals or fairly quickly afterwards. So it's the most useful information. So with these settings, we can look at these settings. We go in the major reversals. The stochastic is reaching overbought, oversold, and overbought. And of course, in a bull trend, strong bull trend, it's overbought for some time. So it makes usually several oscillations within the overbought zone as well as the oversold zone if it's a bear trend, just like it has here, a few oscillations. And the real signal that it completed a weekly low, just from a momentum standpoint, is when the momentum, both of the lines, trend out of in this case, the oversold zone or below the overbought zone. But we want a signal before then. So let's review just closely a market that gets in a strong trend, in this case, a strong bear trend, and where the stochastic hangs in the oversold zone for some time. A bull reversal is not a signal to go long or even get necessarily excited about it's making a weekly low. It could very well, and more than likely, in fact, it's making just a short-term correction. And we don't want to initiate a long trade. And then a bear reversal is a trend continuation, in this case, with the stochastic, in this case, trend continuation of the bear trend. And we can consider adding short trades, initiating or adding short trades as long as the momentum is bearish. So again, when it's bearish, we can add short trades. When it's bullish from the oversold zone and a bear trend, we just don't add short trades on. And if the market comes into a price in a pattern position, when it's at that bull reversal, then that has a possibility, when the bull reversal is made, to have completed the price or the pattern trend. So that's when it becomes important. A bull reversal in the oversold zone, the importance will depend on the price and pattern position. So for instance, let's take a look at this data coming down from the May high. It's more or less in a five-wave decline. In fact, it's not really more or less. It really looks like a five-wave decline. And as we know, at the end of five waves, typically an impulse trend is complete. And then if we look at where the low is as of the lowest bar in this chart, and that's the bar just before it made a bull reversal, it tagged, this was 162% external retracement, what I got labeled a wave 4, and just a few points short of the 100% alternate price projection of what I got labeled as a wave 3, and which, by the way, should be the maximum for a wave 5 if this is a 1, 2, 3, 4, 5. Why is that? You should all know that should be just instantly. If indeed we're going to call this a 1 and a 2 and a 3, obviously the 3 is shorter in price than the 1, and the 3 should not be the shortest of 1, 3, or 5. So the 5 should be shorter than the 3. In other words, if we just put the 100% alternate price projection of the wave 3 from the wave 4 high, that should set the limits on the downside if this is making waves 1 through 5 as shown. So we're at some pretty significant price relationships. We have a pretty good wave count for a 5-wave trend near the maximum where the price should be, and then the weekly momentum made a bull reversal. So I would say, as of the last bar on this chart, is the GDX is in an immediate position to consider a long trade. We don't have to wait for that momentum to get out of the oversold zone because it's made its bull reversal at very significant price relationship to complete a pattern. So that said, if we were at this point in time, what is that? That's the week ending Friday the 8th. Let's go to our daily data as of that point in time and go under the assumption that we're in an immediate position to develop a go-long strategy. So either go long on the GDX, ETF, or consider some mining stocks, gold mining stocks, that are part of the components of the GDX. Well, this is the daily data for the GDX up through the October 8th, and that was the week that the GDX made the weekly momentum bull reversal, indicating that at least a weekly low should be complete and this 5-wave decline should be complete. What would we anticipate following this 5-wave decline? Well, if indeed it's a 5-wave impulse trend, at the least we'd anticipate a correction to this several month decline. I think it's about 4 to 5 month decline. So this is the daily data. So in other words, we should have quite a ways to go. So this is the daily data. And I put two settings for the stochastic down so you can just look at them. One begins with a 13 look back, and the one in the lower one, the 8 look back. You can just see how there's really not much difference between those two. There's a few more what we call the false reversals, the whipsaws, mid-zone here. On the 8, we had the whipsaw. 13, we didn't. And then on the 8, there's a few more also when it gets near the oversold or zone or the overbought zone. So I would go with the longer, a little bit longer look back, just a little bit smoother. So let me just tab these. We're only looking at the one, that's the 13. It should serve as well. Either one probably would be almost as good, but we'll go with the 13. So as of the last daily bar in the chart, we know that the weekly momentum reached or made a bull reversal from the oversold zone, actually. Let me just reduce the data here a little bit. So we see that the daily momentum is bullish, and it's not even near the overbought zone. And if the trend has reversed to bull, if the weekly trend is now actually bullish, is that more than likely the daily momentum is going to get overbought and hang in there quite a while. So for instance, coming off of this high, the main trend was bearish, and because the main trend is bearish, it hung in the oversold zone, made a nice crisp reversal on a correction, came down, hung in the oversold zone, because that was the direction of the higher time frame weekly trend. If that weekly trend is reversed to bullish, then more than likely the stochastic is going to be hanging in the overbought zone for some time, and then make these 2 to 3 week corrections, some correction, then continue the bull trend. Is the GDX in an immediate position for a long trade? From my point of view, it's a yes. We're only 3 to 4 days off of the bull reversal in the daily momentum. We're the first week of the bull reversal in the weekly momentum. And if we were to take a long position, we wouldn't have to put our stop all the way back below the September 29th low. We could put it below this congestion, and I just look at what's the closing low for this area. And let me just put that in, like so. And that would be a stop if we wanted to go long immediately. And again, the rationale for doing that is we just made the weekly momentum bull reversal against a probable 5-wave impulse trend that was several months long. We just made a daily momentum bull reversal. It's just coming off the oversold zone. It ought to remain bullish and be in the overbought zone for some time. So I think this is an immediate position, particularly because we don't have to have our stop any further than below this congestion area. We don't have to have it back here. So once again, I usually would enter on a higher close. My trade strategy would be enter on a higher close with the initial protective sell stop, 29.32, just a tick below this closing swing low. For a probable multi-week trend, without doing retracements or anything else, is just typically, if this market is making a correction and not a new bull trend, but just a correction to that 5-wave decline, it would typically reach around the extreme of the wave 4. That's your basic Elliott wave guideline on a correction to a 5-wave impulse trend. And of course, we would be doing some other retracements, alternate price projections as the trend continued, if it continued as anticipated. So hopefully that all makes sense to you. Once again, you have to be able to think. So trading it's just like any other business. You have to learn to make decisions based on the information that you have. And the better you understand the technical position, in this case based on the pattern, the price, and the dual time frame momentum, the better you understand that, the more experience you have, and just think of it as logically within the parameters of what the technical position is, then you can make high probability decisions. And again, you can always adjust the position size and the leverage so you never have more capital exposure than what your account size calls for and your trading plan calls for. So there's never an excuse not to take advantage of a nice setup like we have here. And by the way, I don't think I even mentioned that this wave 5 looks like it's subdivided nicely into 5 waves also into that September low. So we have the 162% external retracement of wave 4, as well as, it's the 162% of the higher time frame, wave 4. This is the 100% alternate price projection of the wave 3. So we have, really strong price support zone based on the end of wave 5 price target zones. So great setup. So okay, let's see what the market does for us as we add some data. There we go. As of the last bar in the chart, we made a higher close. That would be an entry. And our stop, we already know where the stop's going to be. That's the beauty of this trading also, is before you enter a trade, you know where the stop's going to be. So we bought long 31.14 with a stop at 29.32. So let's add some data and see how we might adjust the stop following either a cycle in the daily momentum or just a typical sort of corrections based on the pattern, that sort of thing, and how we might trade this with multiple units. So the one thing we know is that we can trade one unit, again, adjust the stop as if this were making, let's call it a minor correction. And then we would adjust the other unit as if it's making a more major correction to the entire 5-wave decline. So let's add some data. So before I begin adding some data on, I'm going to just put some simple waypoints, interesting points we want to be aware of on this chart potentially as this market advances. So of course, the wave 4 high, that's just a guideline for a probable target if the market's making a correction against a 5-wave impulsive decline. You learn that from the Elliott wave course. And then we'll just put the simple retracements on, just so we're aware of those. 38% is not relevant, as you know. I'll just take the 78.6% off for now. So the typical retracement against a 5-wave trend is around the 50 to 62% retracements. We always want to be aware of them. They happen to overlap what I got labeled as a wave 2 swing high. So that would be a significant area to be aware of if the market continued to advance. More than likely, a correction would be a little bit greater than the extreme of the wave 4. But we have some waypoints that we want to be aware of if the market continues to advance as anticipated. Okay, let's add some data, and we're going to look for a couple of things to adjust the stop. One is if we get any kind of momentum cycle and a bull reversal in the daily momentum, that'll be a spot on price and the price reversal that the market should not go if the trend is bullish. The other is just look at this pattern. This should be a wave 1 or a wave A, and if it gets to the point where it looks like it's near the end of a wave 5, if this breaks down into 5, then that could be reaching the end of a wave 1 or A, and we'd certainly, on half the position, want to bring the stop very close to the market and keep the stop in the second half of the position back here or far from the market until we've obviously completed a probable, at least, a wave A and then a wave B, and the market has continued higher. Let's add some data and make some decisions. And here we go. No, that's what we like to see right after we enter a trade. That always makes us feel good, and that even makes us feel better. So as of the last bar in the chart, just 2 more bars after we entered on the long side, The daily momentum has reached overbought. Is that significant? Is that an event that we want to make some sort of trading decision against? And more than likely, no. Keep in mind, if the higher time frame weekly trend is now bullish, and if we've completed this 5-wave decline, it should be, the weekly trend should be bullish for several weeks, then the main trend is bullish, and that means the daily momentum is likely to hang in the overbought zone for some time and potentially make some oscillations and reversals in the overbought zone. So it's not a significant event any more than during a bear trend. When the daily momentum gets oversold, that's significant because it does a lot of oscillations and is in the oversold zone for many bars, typically anyway. Even down in here, again, it reaches the oversold zone rather quickly and then remains in it for some time. And it's only when it exits the oversold zone that it was significant, that it indicated a correction was being made. So that's not significant. Let's add some more bars on the chart and see if we get to the point where we might want to adjust the stop. So where are we now with this data? What's that look like to you? Well, it looks like to me that this could be a 1 and a 2, 3 and a 4, or maybe this is the 3, 4, and 5, and we break this down some other way. The point is, this is very impulsive, which is what we want to see for a wave 1 or an A. So this should not be nearing the end of a correction by any means. It may be nearing the end of a wave A or a wave 1. But we can break it down in one of a couple of ways into 5 ways, which would indicate we're probably getting pretty close to the extreme of this wave 1 or A. And on top of that, we're getting near this swing high for the wave 4. So it looks like to me, from my point of view, this would be a time we'd want to get fairly aggressive about bringing the stop quite close to the market, half the position. And I would bring it up to a close below that little swing low, under the assumption that we're getting very close to the end of a wave A. Again, trading is like every other business. You have to make decisions based on the information you have and the experience that you have. So based on the information of the technical position, in our case, the Elliott wave pattern position, the price position, just some basic chart geometry, and some momentum reversal position, this looks like it's in a position we want to bring the stop pretty close to the market. Now, if we were to get stopped out here, it'd just be a small profit on part of the position. But that's a great cushion against leaving the stop much further away on the second half of the position, because we want to hold that position through a correction against this initial advance and the continuation of the trend. That's why you don't get in your mindset that, oh, I didn't make much profit on that, I got out too soon if this is a big bull market. No, you're taking just half the position, exiting probably at a small profit, maybe we'll go between small and reasonable profit. And that does two things. One, should the second half of the position get stopped out before it's adjusted, you minimize the loss and maybe even have a bit of a profit. Most cases, you end up having a bit of a profit. So it's protection. It's good trade management. So let's add some more data onto the chart. Where are we at here? This is interesting position to be in, is that this is called an island reversal kind of day, and we made a bear reversal in the momentum. So is that significant? Well, it's a little more significant now that we're having trouble getting over this swing high. And this is basically, it's not a bearish reversal day, but it's just think logically, opened on a gap up, made a new high, came down and closed near the low of the day. So that would be a signal, just common sense. Let's bring our stop up to a close below here. particularly because we just made a bear reversal in the daily momentum. So again, doesn't mean this is a major top or not, but probably we're at the end of this advance, the initial advance, the wave 1 or A. Let's add some data here. A little bit higher, sideways, sideways, and would have stopped out on the close. So a modest profit on this advance, on one half of the position. Is there a reason to advance this? The only reason to advance it is at the 78.6% retracement, because we've got a strong impulsive trend. This is really strongly signaling that this is not the end of a correction. This should be a wave 1 or A. Let me put that in. Should be making a wave 2 or B correction. And I do this a lot, is I just adjust the stop to a few ticks below the 78.6% retracement. I mean, again, if this is a 1 or A, typically a wave 2 or B is about a 50% to 62% retracement. Happens to be right around the area where we entered the trade. That's not particularly relevant, but that would typically be the limits for a wave 2 or B correction, and certainly not a close below the 78.6% retracement. So I'm going to adjust the stop. It's not a big adjustment from where the stop originally was, but every little bit helps in the long term. So let's add some data and see the next event when we might want to be adjusting the stop once again. So let's take a look at this. Beautiful. Decline right into the 50 to 62% retracement. The daily momentum has not made a bull reversal yet. I suspect if the market is just sideways to up for another day or two, it will. But if the daily momentum makes a bull reversal, then I'm going to bring the stop to the closing low made prior to the daily momentum bull reversal. There we go. As of the last bar in the chart, and that's a pretty strong up day, is that it made a new high, daily high, and then closed, looked like a top tick, made a daily momentum bull reversal. So we can adjust our stop to a close below this closing low. So let me clean the chart up a bit. Here's where we entered. Our stop is, for practical purposes, it's break even. It's a little bit above break even. But, that would be if it closed right on there, because we're looking for a close below 31.53 to exit. But everything seems to be together that this is probably a wave 2 or B. Let's add some data under the chart. And that's looking extremely good for this being a wave 2 or B. Is there a reason to advance the stop on the second unit? Let me go ahead and put some information on here. There we go. So we made the new high, made a new closing high. It's confirmed it's a 2 or B. So we've reached the 50% retracement. But this has just come above the 1 or A high. I'm going to put some price relationships in before we continue on. I want to know if there's any significant target zone above the market that I want to be aware of if the GDX continues to advance and the daily momentum reaches overbought. So we've got our retracements in here. Then let me do the external retracements of this decline. That's another thing we would do. 127, 162. And I'd look at the 162 as the probably maximum upside. Boy, that's right over the 62% retracement of the 5-wave decline. Want to be aware of that. Not too far above the market, 127%. So what's the one other retracement relationship we do? Remember that from the price course. I know you do. The alternate price projection of the wave 1 or A. And that's irrelevant, the 162. The 100% is a little bit above the 62% retracement. And the 62% is right where the market is now. So we basically have two zones to be aware of. The market, GDX, has already reached the minimum target probable if this is an A, a B, and a C. And that includes the 50% internal retracement, 62% alternate price projection of the 1 or A from the 2 or B low. So it's right in there, but the daily momentum's bullish. It's not overbought. So more than likely, it's got a little ways to go. We got a gap up here that's kind of impulsive. I would look that the market probably should not decline below and close below that area if the trend is going to continue bullish. And that's how we adjust our stops. Still quite a ways from the market on the second half of the position, a bit above where we entered. So again, if we did get stopped out, we'd have at least a modest profit on the second half. I'm just going to add some data until we get in a position where we might want to adjust the stop. We have this advance. The daily momentum is overbought. Is that significant? Well, it should be overbought, and it's probably going to remain overbought for a while, just because if the higher time frame trend is bullish. Now, because we want to look at the dual time frame momentum position, let's go take a look at our weekly data as of that point in time, November 16th, when it made this outside bear reversal day with the daily momentum overbought. So this is the last complete week before that day on the daily chart. So a complete week, of course, would be prior to that daily momentum bear reversal. If we look down here as the weekly momentums, they're not overbought. Looks like the fast line is, but the slow line is not overbought. So typically, if the higher time frame trend is bullish, even if it's not impulsive, it's still more so than of these corrective advances because it's already nearing the overbought zone. Typically, it's going to be overbought for 2 to 3 weeks anyway before it completes a weekly high. So there's nothing in the weekly momentum that's indicating we're at or near a weekly high, from my point of view at least. I don't want to be too aggressive adjusting the stop in the long position, but each time there's a certain waypoint to which the market should not exceed, I'm going to bring that stop closer to the market. Because I would anticipate we've got another week or two to go, and a good possibility that we'd reach up into the more typical end of wave C price zone at least. So now if we get a little decline here and then a new high, that would be a condition to adjust the stop. So we got a bear reversal and a daily momentum. I hate to see that already with it only being overbought a few days. There's no reason from my point of view to adjust the stop yet. I'm just cleaning a couple things up here. There we go. Now we have the entry price and our current stop price. So I'm going to see a correction continue to advance before I adjust that stop. Well, I don't think we're going to get that. So we've traded below where the stop is. We haven't closed below it. Now we have. So let me once again. We exited on the close, made a modest profit on both of the units. Certainly, we came into a pretty significant price zone. It certainly wasn't the typical target if this were an A and a B and a C. It was well short of the typical target. And the daily momentum had just reached overbought. Typically with the stochastic, it's going to be overbought much longer. So that's the way it goes. We made a decision based on the information at hand. And yes, market came back quite a bit off of that area, stopped us out for a modest profit at least on the second unit, just as we got stopped out with a modest profit on the first unit. And what's occurred here now, we made a new high, and then we've come closing back into the closing range of what I get labeled the wave 1 or A. More than likely, this is a completed ABC correction, because we shouldn't close back into this range, certainly not 2 consecutive lower closes to the extent we have. So this is another example, and I like to use examples in the course that aren't the perfect examples, where we don't always buy right off of the low and sell within ticks of the high. Is we manage a trade, we manage that trade with 2 units, multiple units. Hopefully we capture more of the advance than we did at this point in time, but at the very least, we protected our position, we made a profit, and I can tell you, if you can do that consistently, steadily, you're going to win at the business of trading. It's that simple. That's what trading is all about. Let's have another lesson with another example. In this final lesson in this chapter, I'm going to do something a little different than the other lessons, as I'm going to take a look at a number of markets in the same manner I would do over a weekend, one when I'm preparing our DT reports, as well as trying to identify what's the probable best trade strategies for the next week. So I'm typically looking at weekly data, daily data, and then a lot of times the intraday data as well. So we'll just go through a few markets, popular markets, and they're ones that I look at virtually every day, but I also write about on a regular basis. So I'm not going to look at them as a trading campaign, like from entry into exit. I'm going to look at them as of the last day on the chart from when I'm recording this. I'm recording it over the New Year's weekend. So the date is up through last Friday the 31st. And we'll look at it as if, is the market in a position for a trade setup? Is it nearing a position for a trade setup? And we'll focus a lot on the momentum position, and a little bit on the price and a little bit on the pattern position. But you'll see that we really don't need to complicate it a lot. If we get a handle on the probable, like dual time frame and dual look back momentum position, look at some simple price and pattern, we can usually identify if a market's at or near a position to consider a specific trade. So let's start out with gold. I've been trading gold since the mid-'80s. I really like the gold market. It does good patterns, makes corrections right at retracements, etc. So we follow that real regularly, and I follow it regularly. So let's take a look at gold. This is the daily data. And as of the last bar in the chart, the first thing, let's take a look at the momentum position. I got 3 different momentum indicators on here, 3 typical ones. My own, the DT oscillator, is up on top, and it's in dual look back mode. That means it's the 1321 look back. And we can see that for several days, almost a week and a half or more, it's been dual look back overbought. And that's in a position from where reversals are typically made. And I have to say that typically a market will make a price reversal within about 4 bars of reaching dual look back overbought. Well, this is the 6th or 7th bar or more. So it's quote unquote very overbought. And then the next is the stochastic and the RSI. You can hardly tell the difference between these two. They're both overbought, and as we know with stochastic and RSI, is just being overbought isn't necessarily a warning that it's at or near a top or a reversal high. With the stochastic and the RSI, it might be a wake-up call, but then we have to look closely at the pattern position, and then it really isn't signaled until it actually makes a bear reversal. But they're all 3 are at least warning that we should be near at least a daily high. That's a high that lasts for several days. So if nothing else, they're all telling us it's not a good time to enter the market. More than likely, it's pretty close to making a daily high. And what I mean by a daily high is the market's likely, gold in this case, to make a reversal and be sideways to down for around 3 to 5 days or so, if not longer, if it's a higher time frame high, like a weekly high. I can tell you that the weekly momentums are bullish and they're not overbought. So more than likely, any decline will be rather short term, and in fact might then set us up for a long trade. So what about the pattern and price position? Let's just take a look at real simple price position coming close to the 62% retracement. What's fairly significant is this is very much a corrective kind of pattern. So it's at least warning us that it's a possibility that gold is in a position or reaching a position to make a corrective high. So it'd be more than a 3 or 5 day high. But either way, everything's telling us it's not a time to get long. If you're a relatively short-term trader looking for those trends that last a few days to a week or two, you might be bringing your stop really close to the market because of the pattern position, the price position, and the extreme overbought daily momentums. So let's take a look at the intraday. The intraday shows real clearly this looks like a corrective pattern. So right short of the 62% retracement, this is the 100% alternate price projection of this last little advance, and it's the 127% external retracement of the last decline. So gold has reached potentially a fairly significant resistance price zone to complete a corrective advance. So that's fairly significant. We know the daily momentums are dual look back overbought. We know here's the 240-minute momentum, also dual look back overbought. So for a relatively short-term trader, it's certainly a setup on the short side. At the very least, we'd want to avoid any long positions, new long positions, until the daily momentum makes another whole cycle and makes a reversal. And for a DT oscillator, would typically reach the oversold area. For the stochastic and RSI, it may not reach oversold, but we'd want to see it make a bull reversal before we consider long position. So here's how I would phrase this, is that gold is in a position to make a daily high followed by at least a 3 to 5 day corrective decline. So if you're a relatively short-term trader, you'd want to have your stops trailing them very close to the market, like the 1 bar low for that matter. If you're looking for a longer-term position, as you'd wait until the next cycle in the momentum and making a bull reversal before positioning on the long side. Let's take a look at another one. Let's take a look at the NASDAQ. The NASDAQ is one of the indexes I follow daily. NASDAQ and the ES are the two main ones that I consider trades, and they usually trend and reverse right about the same time, but typically one or the other is relatively strong or relatively weak. But here's the NASDAQ as of the last daily bar on the chart. Let me just reduce that a bit. And in the indicator window is the dual time frame indicator. That means these green bars on the oversold zone means that the weekly momentums are bullish, just as when they were pink and red, the weekly momentums were overbought or bearish. So the weekly momentums are bullish and they're not overbought. So typically, when the daily momentum makes a bull reversal, then we have weekly and daily momentums in sync, dual time frame momentum position. In this case, to probably complete a corrective decline, followed by the continuation of a bull trend to a new extreme, if it's a correction. So let's take a look here. The daily momentum's bearish and doesn't even look like the fast line's quite reached oversold, pretty close. When we look at this with the daily momentum in this position, we usually say that more than likely the NASDAQ is going to complete a daily low within the next 2 to 3 days. So 2 to 3 days from now. And given that it's been a very shallow decline so far, that's going to it looks like it's going to be a great setup on the long side to continue the bull trend to a new high. So we would be waiting sometime during this next week, and when the NASDAQ's daily momentum either got oversold or made a bull reversal, it would be in a position to have completed a corrective decline. Now, typically, correction would be greater than 38.2%. The reason I have that in there is this can kind of break down into this making a wave for correction, particularly if it's after these 3 days and it's been so shallow. So we're going to be looking real close at this decline. And let me go to the 240-minute data here on these 24-hour markets and actively traded ones. Usually 240-minute data is what I'm looking at. And again, we look at this data, and again, it looks kind of choppy. It looks like a correction, doesn't it? So within the next 2 to 3 days, more than likely, the daily momentum is going to make a bull reversal. And we might have like another whole cycle in the 240-minute momentum. But that's the type of thing that I'd say let's be prepared for a setup on the long side, because the weekly momentum is bullish. And when the daily momentum makes a bull reversal, particularly if it's, hasn't gotten further than the 38.2%, it's pretty shallow, that's going to be a great setup on the long side for a new high. Now, it's not necessarily going to be a big long-term setup, but it'd be like for a 3 to 5 day setup, the kind of trading setup. So that's what we'd be prepared for with the NASDAQ, and probably the other indexes are in substantially the same position. Let's take a look at Bitcoin. Bitcoin is a great market to consider, and you don't have to trade Bitcoin itself, as you can consider the GBTC. That's an ETF. That's the one that we use in our reports, in our DT reports when Bitcoin's in a position, is that we use the execute trades on the GBTC. So here's Bitcoin weekly. And so what's intriguing here is the weekly momentums are dual look back bullish from the oversold zone. So they just made a weekly momentum bull reversal the prior week, not this past week, but the week before that from the oversold zone. And that's usually in a pretty good position to say if a weekly low is not complete, it should be very soon. And by the way, this is weekly closing data. Here's what it looks like in the weekly range data. And these retracements, by the way, are retracements based on weekly closes. So as of the end of this past week, is Bitcoin made a new weekly closing low. So when we get a momentum bull reversal, then we want to identify a trigger that indicates the low is complete, such as, in this case, a higher weekly close. Well, we had the weekly bull reversal, and then actually the next week, this past week, closed lower. But look, it's getting very close to the 62% retracement based on closes, which is not far above this swing low. And everybody that trades Bitcoin is going to be familiar with those levels, which is around 42,000, something around in there up to 44,000. And that's not a projection that it's going lower. This is a wake-up call that Bitcoin is potentially in a great position to consider a long trade on bull reversals in the daily momentum. So let's take a look at the daily momentum and other position of the market. So this is Bitcoin daily, and again, it's on closing data. So look at where we are as of the last bar in the chart. So again, this is the DT oscillator, and it shows the dual time frame. So all of this light green was when the weekly momentum got oversold, and then this darker green, of course, is when the weekly momentum made a bull reversal. And look at where the daily momentum is as of the last day of this past week. It's oversold. So this would indicate we're probably within a day or two, maybe 3, of completing a daily low, daily momentum bull reversal, while the weekly momentums have already made a bull reversal. So this is a great setup, probably at least, in the next few days. So what are we looking for? Is the downside's probably pretty limited. If Bitcoin continues lower to around, I'm just going to round this up, 45,000 down to about 43,000. And that's the 162% external retracement of this last advance. The 78.6% retracement based on closes. Now That's made from the September low, whereas on the weekly, I made it, those retracements were all the way back from the June, July low. So let's go back here. Just based on dual time frame, this is a wake-up call of we're probably very close to completing a weekly low in Bitcoin. So if we make a Bitcoin momentum bull reversal and then close above a minor swing high, that's going to be a specific go long strategy. So here we are as of the close of Friday, and it's oversold. So I've drawn a line across. This was just Thursday's closing high. It was a little up close before I went lower on Friday. And a Bitcoin close above 47,156 would be an actual go long strategy given that the daily momentums are oversold. So great strategy coming up. Now, is it going to result in another huge bull trend to a new high? Not necessarily. But anytime Bitcoin's in a position to complete a weekly low, the percentage change in these multi-week trends can be very substantial. So Bitcoin is definitely a market we'd want to be looking at over the next few days on the long side. So it looks like NASDAQ and the other indexes probably in the next 2 or 3 days on the long side. Bitcoin on the long side. Gold is in immediate possession on the short side, at least for the short term, next few days. Let's take a look at Google, the Google stock. So there's Google daily data, and this is the dual look-back data. Google looks, of course, a lot like NASDAQ does because it's one of the major components of the NASDAQ and one of the top, technology stocks that, boy, has a lot of volume, a lot of people trade it. So it's a great stock to be aware of, and particularly when you do a filtered down approach. If your analysis and trade strategy setups indicate that the NASDAQ is in a position to make a low and then a continuation of a bull trend or a reversal to a bull trend, is that then you want to look at what's the relatively strong components within the NASDAQ if you prefer to trade the stock itself. So Google looks a lot like the NASDAQ in that the daily momentums are bearish. Only the fast line's oversold. Let's go to the weekly. The weekly momentums are bullish. So we just want to be focusing, as long as they're bullish, on the long side. And the next daily momentum bull reversal would be very simply a dual time frame momentum setup on the long side to complete a corrective decline. And again, just like the NASDAQ, looks like it's going to be a fairly mild correction. So it would be another market. And of course, a lot of the stocks, component stocks, technology stocks, if we prefer stock trading, we'd want to be looking at over the next few days for at least another probably week or two, a net bull trend, and probably to a new high, certainly above the high last week. So that's how we look at these markets and look to see if they're at or near a setup. And it's, in this case, some of these setups are probably 2 to 3 days away. But if we're aware of those, we basically just set an alert on the chart for whatever technical reversal or technical signal would be the final signal to fall into place, then to consider a specific trade strategy. For instance, on Google, let's just go backwards here. Google, I would set an alert on just the oscillator if it were to get oversold. Is this the 8? Yeah, 855. So if it just reaches oversold, now the fast line is oversold, but if both lines reach oversold, like right in here and right in here, I'd want that alert to pop up and say, okay, take a look at it now and see if it's still in a position to complete a corrective low. I do the same with Bitcoin. It's already oversold, so I just put an alert on. We call them the crossovers. So, we can use whatever oscillator that we want to use to make a bull reversal. I've already got some of the DT oscillators saved. And so I'd be looking for a crossover on the 8. And then this is called a crossover with, if we wanted to get a crossover and then taking out the prior day's higher low. So if the 8 daily momentum made a bull reversal and then exceeded the prior day's higher low, this alert would pop up. So not only did we have the reversal, but we had the follow through. Again, we'd look at each one of these. In this case, let's see, this is gold. In that case, I would want to see an alert on a bear reversal, and sometimes just a trading 1 bar low or a lower close, that sort of thing, close below. So that's how we look at a number of markets. Of course, we look at a lot more in our reports, and it just depends on what you're trading. If you're trading the stock market, for instance, you'd want to be aware of the major indexes, and then you can look at the sectors, and then you can look at the components of those sectors as well.